Hi, welcome to Leaders in Lending. This is Lynn Sautter Beal. We're joining you today from CBA Live in Orlando, and I have Aaron Rykowski and Mike Reynolds here joining us on the panel. So, Aaron, Mike, would you take a minute to introduce yourselves and tell our listeners what you do?
Oh, sure. Hi, I'm Aaron Rykowski. I'm the Chief Compliance Officer for WesBanco, headquartered in Wheeling, West Virginia. We're about a 28 billion asset bank at the current time, with offices in 9 different states. And I'm responsible for all of our regulatory compliance programs.
And I'm Mikey Reynolds. I'm Director of Compliance for Zions Bank Corporation. We're based in Salt Lake City, Utah, and we're almost about 100 billion in assets.
And Aaron and I realized leading up to this that we live probably a couple hours apart in Ohio and have met each other for the first time in Orlando, Florida, which is always fun. And both of you were on the CFPB committee for Consumer Bankers Association. So can you kind of provide our listeners with kind of an overview of how CBA and then its members engage with the CFPB?
Well, this was a lot clearer answer a couple of months ago. Right now, the jury's out. We really don't know how we're engaging with the CFPB at present, given some of the goings on in Washington. But, ways that we have in the past is by having dialogue between the membership of CBA and the CFPB, interacting with that agency. And it's really unique that we have a committee that is dedicated to relationships between the banking industry and a particular regulator. And I think that's what makes this committee unique. The regulator has direct supervision authority over banks with 10 billion in assets and larger, and it's a unique structure. So having a committee that is able to take the concerns of the association's memberships and have that dialogue at times directly with the agency to provide thoughts, feedbacks, concerns, where we think that some of their rulemaking or some of their activities can help benefit consumers and benefit our customers and the membership and communities at large. I think that that's one of the ways we really try to engage. And, we'd also get feedback from our membership to provide input to the Consumer Bankers Association that they use when they draft comment letters or when they have discussions directly with the regulators as well. So in normal circumstances, that's really how we have historically engaged. Right now, jury's out.
I would say for us, there's still that ongoing, or up until maybe 2 months ago, the touch points that we would have with the CFPB, kind of focusing on what Aaron said too, coming together in our committee to then, discuss kind of current trends, things that are going on with exams, or hotspots up until about 2 months ago, but still, trying to abide by the law for what it is right now.
Mm-hmm. Sure. And I think, a lot of us have talked about that recently, just the uncertainty, and it's much more straightforward and easy to build a compliance organization in a period of clear rules and clear oversight. But, given the changes in the administration, this is it's a hard one to forecast. But, if you had to say, what do you think is going to happen with CFPB regulations in the year ahead? How do you think that those may change in ways that impact the CBA members?
I think a lot of that depends on the time frame and confirmation of a new director. So, obviously there's an interim director, and now there's been a couple of them since the new administration has taken office. But really understanding the thought process and priorities of the administration and the new director and what that's going to look like. So right now it's hard to forecast. I know the current nominee for the director has experience on the FDIC board, so he knows what it's like to be a bank regulator, to be a part of an agency, to lead an agency, to manage through that. So what we're hoping for as members is we kind of get back into common sense regulation. Enforcement, I believe in enforcement. I believe in supervision, but enforce the regulations as they are, as they're written, examine based on the exam manuals as they are and as they're written, and have that transparent dialogue with your banks when you're in there. Part of my background, I'm an ex-examiner. I was a FDIC examiner years ago, and that was always the mentality that I took, here's the exam manual, here's the rule. How are you complying with this? So when we're talking about supervision and regulation, I would look for and expect the agency to adhere to the rules as they're written and follow their exam manuals. At least that would be the hope.
Yeah, that's a great point. I mean, we still have to comply with rules that are codified, currently, and all of these pending rules that are still under the Congressional Review Act, and we have some time still to go for some of those. I mean, it's still status quo for us. It's nothing normal. And I would say even since 2020, when COVID hit and we had a bunch of regulatory reform because of consumer harm and whatnot, I mean, it's just, business as usual for us right now. So.
Sure. Yeah. And we work with a number of banks and credit unions on our platform, some banking as a service providers, some traditional banks that originate and retain, as well as credit unions. So while we're not directly regulated by the prudential regulators, we do get state examinations and we support a variety of examinations. And we, had a partnership with the CFPB for a period of time. And I think that's the one thing I was just talking to some other folks earlier that the banks don't want to do consumer harm, right? Like you can't harm your customer. You still will do those things even in the absence of the CFPB maybe coming in. So if the CFPB, if some of the trends towards defunding and decreasing the size of the CFPB and even some of the other regulatory agencies continue or accelerate even. Anything that you can see on like broader implications for what that means for the banking industry as a whole?
Well, if you see kind of a shrinking of the exam workforce, I think that'll, depending on how they go about that, I think you could see a lot of broad implications there, both for consumers and consumer protection regulation, but also safety and soundness and risk management examinations. The way typically these things happen is they look at seasoned examiners at the top of the pay scale and offer them, early retirement options, or you look at people that are coming up through the ranks and maybe going through various schools and training and onboarding that have not earned their commission yet to write exams, and they may be let go. They may be probationary employees or ones that have not fully gone through the education and onboarding process. So the exams still have to happen, right? From the prudential regulatory side, there's rules that you have to come in every so often to look at consumer compliance, to look at community reinvestment, to look at compliance with fair lending laws. And, a reduced examination workforce is going to leave less resources to examine banks. But you also lose that relationship that you've built with your regulators. The end goal is a safe and sound banking system, a safe and sound bank, and nobody wants to do harm to consumers. I've been in banking over 20 years, and never once have I been in a room where somebody said, well, how much in fees can we get on this? Or how can we really, do something other than what's in the best interest of our customers? But, you still have, the regulatory side, and people need to come in, and a lack of experienced examiners that don't have the institutional knowledge, that don't have that relationship with management, that can't have those sometimes hard conversations. How did you think this through? Why are you doing this way? It could lead to things that don't get caught, or it could lead to questions that don't get asked, or issues that don't get resolved. So, when I would look at this, like, anybody would listen to me anyway, but I would say, just kind of proceed with caution when you look at right sizing, if that's the right term, an examination workforce to make sure you still have the right people looking at the right things on the right frequency.
Yeah, and I would say that even though there's a lull right now, from that perspective, I mean, we're still gearing up for potential state regulation then to kind of come in and swing. We've got, the midterms coming up, I would say, in about a year and a half. And so that may be another pendulum swing that we have to then prepare for, or a moot house, where, there's a lot to be unexpected, I think, right now. So.
Yeah, and I think that the impact of a kind of patchwork of state regulations that may be very strong would be very difficult to deal with. Even for a fintech like ours that lends nationally or works with banks to lend nationally, those state regulations can be very difficult for us to manage our business and understand volume and ensure that we're applying them, like the Colorado law, if we had to put that into effect, and spending time and money and certainly a time and money expense on banks for especially with uncertainty and less clear. I really liked what you said, though, Aaron, about less experienced examiners and kind of the team where they really maybe knew the bank partnership and had insight there. Particularly as it relates to, say, use of AI, partnerships with fintechs, or new technologies. What would you, one, with some of the changes in the regulatory bodies right now, like what do you think the risks are there in their ability to oversee those? And I guess I would say too, like, how can the CBA members think about working with them to maybe help educate them on the new technologies or partnerships that they have?
It's a very broad question. So I think AI is becoming more prevalent. Generative AI is becoming more prevalent, and I think that banks and through just using it directly, developing it directly, or partnering with fintechs offering it directly, they're looking to find ways to go to market and work with their customers in the most efficient way possible. And this is kind of a way to do that. Really looking at the risks of AI, it's to me, starting with your third-party management or risk management program and being sure you understand what the service is, what the AI can do, what the variables are. Because again, the compliance risk is always there, and it's still there. And as Mikey mentioned earlier, the codified rules and regulations are still there. We still have upstart in the lending space, and looking at AI and algorithms used in lending for automated decisioning and approval. You still have to ensure that those models that you're using, the AI you're using, is operating fairly. Those rules and those laws, equal credit opportunity does not go away. You're still going to be examined for it. You still have your prudential regulators that can look at fair housing if you're in the mortgage space and using some AI to help with your decision making. So, the basic blocking and tackling of your compliance program does not change, regardless of, the political environment or the regulatory environment. And just be honest, because things ebb and flow. We've seen a lot of ebb and flow over the last 10 years as far as which administration is currently sitting in the White House or which administration or which party is currently controlling Congress. You see swings back and forth. So the rules are still the same. And making sure that you're doing your own due diligence and understanding how these things are working, it's central to what we're trying to do from a compliance perspective and how we govern the use of AI in our banks and in our shops.
That's a great point. I mean, specifically talking about AI and, focusing on operational effectiveness kind of in this lull from a regulatory perspective that we're in. I mean, you still think that, these fraudsters out there are using fourth generation bots as we move into fifth generation technology and things like that, where they're starting to outsmart the banks. As Aaron mentioned, we have to be very up on these different models or things that, than AI is coming out with, and then being able to kind of defraud the fraudsters. So also focusing on, that operational effectiveness and reducing operational or, losses.
Mm-hmm. And I certainly think with the technology, becoming more sophisticated and the growth of and use of AI in various forms, whether it's the way that we use it or generative AI, getting field examiners up to speed and trained, or people at the regulatory bodies, especially if they're shrinking and more experienced examinators are rolling off is only going to be more of a challenge.
Oh, absolutely. When we're having these discussions, and what we've been having for the last several years with our regulators is our use of AI and is how our governance processes work, and what does our oversight look like, and how does that integrate? Like Mike mentioned, you have to outfraud the fraudsters. The fraudsters are out there; they're using AI to counter our AI. So how do those interplay? And our examiners have been with us as we've gone down this journey, understanding how we're making the decisions we're making, the due diligence we're doing, the testing we're doing, the evaluation of the results, and the loss of that experience and the loss of the folks that have gone on that journey with us. I think that would be a blow for us in how we serve our customers, and more importantly, how we protect our customers. Because a lot of AI too, it's not just granting loans and giving credit. We use a lot of AI on the back end to monitor for fraud and different things there. So, the examiners that have kind of grown up with us in this space, them not being there could really be, detrimental to some of our efforts, and having to bring newer ones up to speed on what we're doing, could be, time consuming and really put a damper on some of our efforts.
Yeah, we've certainly spent, despite not being a bank, or having a bank as part of our organization. We've spent a lot of time with the regulators over the years, and I've met with the FDIC along with our head of government affairs and our chief risk officer and the OCC. And so we've taken the stance as a fintech to be very proactive in our regulatory outreach and to kind of open our doors and try to help drive that education forward. And knowing that then we're working with all of our bank and credit union partners to support their exams. And it is a constant, there's I think volume and velocity of information right now and changes is very high, compared to, where it may have been several years ago. How do you think about, on your committee through the CBA, staying up to speed with what's happening with the CFPB and then using that to help kind of educate your members or drive your agendas internally?
Yeah, I can go for it first. I would say specifically, I mean, as we even then share these secrets, across the committee members and whatnot, we try to focus more on sharing what I think are best practices and still building up maybe our RCSA, COSA framework, CMS, frameworks and things like that to then better be able to attack these types of things. You have to have a skilled staff. And as we talk about, potentially, lead examiners that have many years of service and many years of experience kind of going off. I mean, we have a new generation, I think, that will eventually come in where they have a little bit more of these heightened skill sets too. So,
yeah. And I think, engaging through our committee, obviously there's some things we can talk about. There's some things we can't talk about. But what I think is unique about the compliance and risk community is there's no competition in compliance. Right? Everybody has to comply with the rules. They apply across the board to all of us. And, when you look at the discussions we have, what is working, what is not working? How do we risk assess certain practices? What are the things you consider in your risk assessment that I might not consider in mine, and vice versa? So, these are things where we're talking about the framework of our compliance management programs and getting best practices from each other and how we navigate through, any time really, but really through uncertain times like this. This is a time you might use the term lull. I think it's like, right now we're not hearing as much from our regulators. So it's a time to pause, breathe after what we've seen the past several years with the volume and pace of change, and shore up our compliance programs. Not that they were, substandard to start with, but take the time to kind of go through and button up things that may not have gotten as much attention because we were focusing on other issues, or better document some of our processes and some of our methodologies and different things. So this is a good time for us to collaborate and kind of talk through what we're seeing and what we want to go from here.
I would even say that it's still, an emphasis for us to focus on our other regulatory bodies that really aren't having a lot of fluctuation right now. Many of us are larger institutions that are regulated by the OCC, the Fed, the FDIC. So there's still that oversight function there.
True. We're kind of focused on the CFPB in this conversation, but there's certainly the rest and then all the states as well. I really like that idea of like, that's, if you are having a little bit of a lull or a little bit of quietness, like taking the time to, kind of revisit your, make sure your house is in order, make sure you're doing anything else. I guess any maybe kind of bold predictions for what you expect to see from the CFPB over the next, I'll just say few months or even quarter. We'll make it short because I think even trying to do a year is probably unreasonable at this point.
I think it's really hard to tell. I mean, I think that my personal prediction, I think, there's the rules that they've put out, some of the final rules, they're subject to congressional review, but some of them aren't, right? So maybe we focus on the known at this point. So I think the 1071 small business rule, that's out there. There's litigation around that, but I think the CFPB has to finalize that. It's something that there is a consent order. I think a lot of people forget, well, maybe they can just go away. No, they can't. I mean, court is forcing them. You have to do this. But I think a prediction from me on that side might be we see a new proposal that substantively changes what the requirements are going to be. Because I think that's been where the industry and the Bureau have butt heads a little bit is Dodd-Frank says thou shalt collect this. CFPB's rule said thou shalt collect this plus all of these other things as well. So I think that we may see a proposal that shifts more towards what's in the Dodd-Frank Act itself there. And I do think we'll see continued movement on 1033, the open banking rule. I don't think that's going to go anywhere, because I think that that's something where it's going to open up information flow between banks and fintechs, between fintechs and data aggregators and different things. So that has the potential to really change how we do business. And I think that that's not something that this administration will likely touch. So I think that that's going to be something that is going to move on status quo. So I think that's going to stay status quo, but I think we'll see a new proposal on 1071.
Aaron hilariously pulled out a magic 8-ball in one of the sessions that he moderated earlier, and I would say that that's exactly
an actual magic 8-ball, you brought
I brought a literal magic 8-ball.
That's great.
Yeah, and that really is kind of the environment that we're in. And I'll just emphasize maybe on what Aaron said is that 1033, I think that's one of the bigger ones that we're still going to see an emphasis and focus on, and it's more about the potential for future acquisitions of customers. It's not just about creating less barriers for customers to be able to then see their data across multiple institutions. It's also to then be able to create, some competition within the market, and then kind of start to, really pull into focus the fact that you want to increase your volumes for both deposits, loans, et cetera, within your institution. So,
well, thank you, Aaron. Mike, appreciate you joining us today and taking the time out of your schedules to chat with us at Leaders Lending.
Yeah, it's been a pleasure.
Thank you.